Delivery and settlement in financial markets, future and options, exploring key concepts of contracts and processes. Overview. Introduction to delivery and settlement. Delivery and settlement in futures contracts. Delivery and settlement in options contracts. Comparison between futures and options settlement. Regulatory and operational considerations. Introduction to delivery and settlement. Understanding delivery. Delivery involves the transfer of cash or the underlying asset between parties involved in a transaction, ensuring smooth market operations. What is settlement? Settlement is the final step in a transaction process where obligations are completed and ownership is officially transferred. Importance in financial markets. Both delivery and settlement are vital for maintaining trust and efficiency in financial markets, impacting all participants. Key concepts and terminology. Delivery date. The delivery date refers to the specific date when the asset is transferred to the buyer. Settlement date. The settlement date is the date when a trade is finalized and funds are exchanged. Physical settlement. Physical settlement involves the actual transfer of the underlying assets such as commodities or stocks. Cash settlement. Cash settlement allows for the payment of cash instead of the physical asset, often used in derivatives markets. Importance in financial markets. Vital role of delivery. Delivery mechanisms in financial markets are essential for maintaining liquidity and ensuring the timely transfer of assets. Settlement efficiency. Settlement processes enhance market transparency and help mitigate counterparty risk, ensuring safer transactions for all parties involved. Fostering market confidence. Reliable delivery and settlement practices foster market confidence, encouraging more participants to engage in financial markets. Understanding futures contracts. Definition of futures contracts. Futures contracts are agreements to buy or sell an asset at a predetermined price in the future. Standardization and trading. These contracts are standardized and traded on exchanges, which helps in facilitating efficient trading. Price determination. Futures contracts allow traders to lock in prices for future transactions, helping in price risk management. Physical versus cash settlement. Physical settlement. Physical settlement involves the delivery of the underlying assets to fulfill the futures contract, impacting the buyer and seller directly. Cash settlement. Cash settlement is based on the price difference at contract expiration, providing a simpler, more flexible option for traders. Market implications. Each settlement method has its own implications for market participants, influencing trading strategies and market dynamics. Process and timeline of settlement. Trade confirmation. An initial step in the settlement process involves confirming trade details to ensure accuracy and agreement between parties. Margin requirements. Understanding margin requirements is essential as it dictates the collateral needed to secure trades and manage risks effectively. Final settlement. Final settlement is the last step where the transfer of assets and payments occur, completing the transaction process. Risk management timeline. A clear understanding of the settlement timeline is critical for effective risk management and timely decision making. Understanding options contracts, rights and obligations. Options contracts provide the buyer with the right to buy or sell an asset without any obligation. Specified price and date. Each options contract outlines a specific price and expiration date by which the asset can be traded. Flexibility for traders. The flexibility of options contracts makes them a popular choice among traders seeking varied strategies for investment. Exercise and assignment procedures. Notification of clearinghouse. When exercising an option, the buyer must promptly notify the clearinghouse to initiate the assignment process. Assignment to seller. After notification, the clearinghouse assigns the obligation to a seller, completing the transaction process. Importance of understanding. Grasping the exercise and assignment procedures is crucial for successful options trading and managing risks effectively. Physical versus cash settlement in options. Cash settlement overview. Cash settlement is typically preferred for options tied to indices, allowing smooth transactions without asset transfer. Physical settlement overview. Physical settlement involves the actual transfer of underlying assets, which is necessary for certain types of options contracts. Advantages of each method. Both cash and physical settlements have their advantages depending on the market context and investor preferences. Comparison between futures and options settlements. Futures contracts. Futures contracts require mandatory delivery of the underlying asset at a predetermined date, shaping trading strategies. Options contracts. Options provide flexibility, allowing traders to choose whether or not to exercise their contracts, allowing for diverse strategies. Market dynamics. Each contract type has distinct market dynamics that influence trading approaches and risk management practices. Risk management strategies. Importance of understanding risks. Understanding delivery and settlement is crucial for creating effective risk management strategies tailored to specific contracts. Unique risks per contract type. Each contract type presents unique risks that participants must recognize to mitigate potential issues effectively. Market participants and their roles. Hedgers. Hedgers use financial instruments to mitigate risk associated with price fluctuations in the market. They aim to protect their investments. Speculators. Speculators seek to profit from market fluctuations by taking on risks. They utilize various strategies to capitalize on price changes. Market makers. Market makers provide liquidity to the market by buying and selling securities. They ensure there are always buyers and sellers available. Regulatory frameworks and compliance. Role of regulatory bodies. Regulatory bodies are critical in establishing rules and guidelines that ensure market integrity and fairness in transactions. Importance of compliance. Staying informed about regulations is essential for participants to ensure their operations comply with the established rules. Operational challenges and solutions. Delays in settlement process. Delays in the settlement process can hinder market efficiency, causing potential losses and dissatisfaction among stakeholders. Discrepancies in transactions. Discrepancies in transaction records can lead to confusion and errors, negatively impacting operational reliability. Importance of addressing challenges. Identifying and addressing operational challenges is essential for maintaining smooth and efficient market operations. Technological advancements in settlement processes. Efficiency improvements. Technological advancements have streamlined delivery and settlement processes, leading to faster and more efficient operations. Risk reduction. Innovative technologies help minimize risks in settlement processes, enhancing security and reliability in transactions. Blockchain technology. Blockchain is revolutionizing settlement processes by providing a decentralized and secure framework for transactions. Conclusion. Importance of delivery and settlement. Understanding delivery and settlement is essential for effective participation in financial markets, especially for futures and options. Enhancing trading strategies. Mastery of delivery and settlement processes can significantly enhance trading strategies and decision-making effectiveness. Compliance in financial markets. Proper understanding of these processes also ensures compliance with regulatory requirements in trading activities. Thank you.